Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're starting with a major development in the Canadian alternative lending market, the merger of Fairstone Bank of Canada and Home Trust Company. This merger, first announced back in March 2024, has now been finalized. It received the green light after gaining regulatory approval and meeting all necessary closing conditions. This union brings together a host of well-known brands under the parent legal entity Fairstone Bank, including Home Trust, Oaken Financial, Home Bank, Fairstone, Eden Park, and FIG. Leading the charge in this new chapter is Scott Wood, who will continue as President and Chief Executive Officer of Fairstone Bank. He'll be joined by Stephen Smith, Founder and Chief Executive Officer of Smith Financial Corporation, who will serve as Chair of the Board. Yusri Basada, previously the Chief Executive Officer of Home Trust, will take on the role of Vice Chair of the Board. Scott Wood expressed his enthusiasm about the merger, stating, "I'm thrilled to join forces with the excellent team at Home Trust and combine our expertise to continue to improve and grow our businesses." He emphasized the merger's potential to enhance their ability to offer a wide range of financial products, including residential and commercial mortgages, personal loans, guaranteed investment certificates, and credit cards. Stephen Smith shared a similar sentiment, highlighting the increased capacity to address unmet financial needs across Canada. Uniting these two great companies enhances our ability to serve the millions of Canadians whose financial needs are often overlooked by traditional banks, he noted. This collaboration aims to expand Fairstone Bank's reach and market presence, positioning it as a leader in Canada's alternative lending sector. The merger significantly bolsters Fairstone Bank's operations, now working with over 4,700 mortgage brokers and serving 2 million customers through a network of more than 255 branches nationwide. Smith Financial now holds a majority voting interest in Fairstone Bank, while Centrebridge Partners, L.P., Ontario Teachers Pension Plan Board, and management retain minority stakes. Smith Financial Corporation, founded by Stephen Smith, is a family enterprise with a diverse portfolio that includes holdings in Canada, Guarantee Mortgage Insurance Company, First National Financial Corporation, Glass Lewis & Co., and Peloton Capital Management. This merger not only strengthens Fairstone Bank's position, but also reinforces Smith Financial's presence in the financial services sector. Let's delve into the changes brought about by the Trust in Real Estate Services Act, or TRESA, which started its rollout in Ontario back in 2020. This act replaced the 2002 Real Estate and Business Brokers Act and was introduced in a three-phase approach. It's heavily backed by the Ontario Real Estate Association, aiming to increase transparency and fairness within the industry. Phase 2 of TRESA, implemented in December 2023, brought some significant reforms. One of these is the transparent offer process, which allows sellers to disclose not just the price of offers, but also details like the deposit, closing date, and any conditions attached. This move is seen as a step towards more transparency, particularly during bidding wars, which have been a source of controversy in the past. Additionally, the term customer has been replaced with self-represented party, signifying individuals who do not have a brokerage relationship. This means that anyone receiving brokerage services must now enter into a representation agreement, becoming a client of the brokerage. The new rules also grant brokerages the option to offer designated representation, a model that's been used in provinces like Alberta. This allows a brokerage to represent multiple clients in a transaction without it resulting in a multiple representation situation. Furthermore, TRESA has expanded the powers of the Real Estate Council of Ontario, or RECO. Previously, RECO's disciplinary committee could only handle allegations of non-compliance via its code of ethics. However, under the new rules, the committee can now suspend, revoke, or apply conditions to a realtor's registration, introducing an updated code of ethics for the province. Realtors like Heather Kennedy from Newmarket have praised the changes, particularly the option for sellers to disclose the content of offers. Kennedy believes this transparency could help build trust in realtors and the buying process, even though it might not necessarily temper prices in a hot market. However, she also notes that the rollout felt disorganized, with many changes causing confusion among realtors and their clients. One of the contentious issues remains multiple representation, where the same realtor represents both buyer and seller in a transaction. Unlike British Columbia, where it's banned, Ontario only strongly discourages it. Kennedy observes that this situation still occurs frequently, without much investigation or consequence. On a related note, the Realtor Cooperation Policy, introduced in January 2024, prohibits realtors from promoting listings more than 3 days before they're on the multiple listing service. This move aims to prevent realtors from exclusively marketing properties to their own clients before officially listing them, a practice seen as unfair to other buyers and realtors. Looking ahead, the Ontario Real Estate Association has released a white paper outlining 9 policy recommendations for TRESA's third phase. These proposals aim to enhance consumer confidence, improve realtor education, and deter bad behavior with stronger penalties. One recommendation is to require auctioneers dealing in real estate to register with RECO, closing an exemption that poses risks for consumers. OREA also suggests mandatory written disclosures for guaranteed sales and additional rules for latent defects. They advocate for ombudsperson oversight to align RECO with other government agencies, enhancing public confidence in its programs and processes. On the educational front, they propose a 2-year articling and mentorship requirement for new registrants and the use of specialty certification designations. Mortgage rates are waking up from their holiday slumber and starting to move in different directions. Depending on whether you need a default insured or uninsured mortgage, those rate changes are moving in opposite directions. Among the most aggressive national lenders, we've seen some notable shifts over the past week. For uninsured mortgages, the 3-year fixed rate has increased by 15 basis points, and the 5-year fixed rate has risen by 10 basis points. Meanwhile, in the insured mortgage category, the 1-year fixed rate has decreased by 30 basis points, and the 2-year fixed rate has dropped by 10 basis points. However, the 3-year fixed rate has increased by 10 basis points, while the 5-year fixed rate has decreased by 5 basis points. Bond yields, which typically drive fixed mortgage rates, have been zigzagging for months, causing uncertainty in the market. However, with a series of significant economic events on the horizon, including dual central bank rate announcements, new trade policies from the United States, and Canadian and U.S. inflation numbers, we might see a new trend emerge. If you're planning to secure a mortgage in the near future, consider locking down a rate hold for 120+ days to avoid any surprises. There's still solid value in the uninsured 3-year fixed space, led by Pine and Radius Financial. Additionally, True North Mortgage's short-term insured specials are worth considering. Don't overlook regional lenders, as they often offer competitive rates compared to the larger national banks. For instance, in the insured mortgage realm, Butler Mortgage in Alberta and Ontario and Vancity in British Columbia have attractive 3-year offers. Robert McLister, a mortgage strategist and interest rate analyst, suggests that while predicting the future of mortgage rates can be challenging, staying informed and prepared is key. He recommends keeping an eye on regional lenders for potentially better deals and maintaining flexibility with your mortgage plans. The Greater Toronto Area's luxury housing market is experiencing a significant surge in purchase activity, driven by recent interest rate cuts and robust equity markets. Data from RE/MAX Canada reveals a notable rebound in the market, with sales of homes priced at $3 million or more, climbing 41% year-over-year in 2024. The Bank of Canada's consecutive 50 basis point rate cuts played a pivotal role in igniting demand for high-end properties in the region during the fourth quarter of 2024. Specifically, sales in the $3 million and above bracket totaled 364, a sharp increase from 259 in the same period in 2023. Homes priced at $5 million or more saw transactions surge by 59%, while those exceeding $7.5 million rose by 41%. Christopher Alexander, president of RE/MAX Canada, attributes this upswing to a combination of pent-up demand and reduced borrowing costs. He stated, "The impact of the first and second 50 basis point rate cuts by the Bank of Canada radiated throughout the Greater Toronto Area in the fourth quarter, jump-starting demand for high-end properties both within the city and suburbs. We've been expecting a surge in top-tier sales activity as the economic climate and corresponding pause in buying intentions prompted a buildup in pent-up demand. The fourth quarter did not disappoint. Throughout 2024, luxury home sales in the Greater Toronto Area grew by 4%, with 1,513 homes sold at or above $3 million. Higher-priced properties experienced even greater growth. Sales of homes priced at $5 million or more increased by 21%, while homes over $10 million rose by 17%. Despite Toronto's higher land transfer tax, implemented in January 2024, the luxury market has adapted. Sales in the suburban 905 area represented nearly half of all transactions in the $5 million plus range, a notable increase from 36% the previous year. In addition to interest rate cuts, strong equity market returns in Canada and the United States have provided affluent buyers with the capital to invest in real estate. Alexander noted that profit-taking was widespread at year-end, with many stakeholders converting paper wealth to material wealth. And similar trends were observed in U.S. cities like Miami and New York. Looking ahead, the momentum from late 2024 sets the stage for a potentially robust luxury market in 2025. However, supply remains a concern. While more listings are expected, demand from sidelined buyers may continue to outpace availability. Affluent buyers are optimistic, supported by favorable market conditions and extended insurance coverage from Canada Mortgage and Housing Corporation, which is expected to ripple through various price segments. However, Christopher Alexander cautioned against overconfidence, citing potential political shifts in Canada and the United States as factors to monitor. These shifts could influence market dynamics and impact the luxury housing sector. In a surprising shift within the Canadian real estate landscape, seniors are now more likely to have a mortgage than young adults, according to recent data from the Bank of Canada. This trend marks a significant departure from previous generations, where younger individuals were more inclined to purchase homes early in their lives. The data from 2024 indicates that nearly half, or 49% of mortgage debt, is held by Canadians aged 45 to 64, often considered the prime earning years. Meanwhile, those aged 35 to 44 hold just over a quarter, or 26% of mortgage debt. This means that 3 out of 4 outstanding mortgages are concentrated within these age groups, leaving the remainder split between younger adults and seniors. Interestingly, the data reveals that Canadians under 35 years old make up only 12% of mortgage borrowers, while those aged 65 and older hold 14% of mortgages. It's a curious distribution, especially considering that the 20 to 34-year-old demographic is actually larger than the 65-plus group. This suggests a shift in home ownership dynamics, with more households carrying their mortgages into retirement. This trend is further highlighted when examining the age of borrowers at the time of mortgage origination. Although nearly half of current mortgages are held by individuals aged 45 and older, a significant portion, 52%, originated when the borrowers were younger than 45. However, only 23% of these originations involve borrowers under 35, indicating that today's young adults are less than half as likely to own a home at the same age compared to previous generations. One might wonder if seniors are taking out mortgages as part of downsizing after retirement, but the data doesn't support this. Despite making up 14% of current borrowers, only 7% of mortgages were originated by those aged 65 and older. This suggests that more seniors are simply continuing to carry their mortgages into retirement, which aligns with the rapid growth of reverse mortgage debt in Canada. In fact, reverse mortgage debt has become one of the fastest-growing segments of lending in Canada. This type of debt allows seniors, who may be cash-strapped but property-rich, to tap into their home equity. Recent filings with the Office of the Superintendent of Financial Institutions highlight a significant increase in reverse mortgage debt, underscoring the financial pressures faced by many seniors. As we analyze these trends, it's clear that the landscape of homeownership in Canada is evolving. While seniors are increasingly likely to hold mortgages, young adults are finding it more challenging to enter the housing market. This shift could have long-term implications for both the housing market and the broader economy, as more Canadians carry debt into their retirement years. A recent report from TransUnion has shed light on the growing financial concerns among Canadians, revealing that more than a quarter, or 26%, of individuals expect they'll be unable to fully pay at least one bill or loan. This troubling statistic persists despite recent interest rate cuts by the Bank of Canada, indicating that financial stress is a significant issue across various generations, particularly for millennials and Generation X. Millennials, who hold the largest share of Canadian debt, amounting to $911 billion, are currently the most anxious about meeting their financial obligations. An alarming 35% of millennials report that they cannot pay at least one debt in full, which surpasses the concerns of other generations. Generation X, who are on the brink of retirement, also face notable financial pressures, with 51% experiencing financial strain. Adding to these challenges, a significant 63% of Canadians do not foresee an increase in their household income over the next 6 months. This lack of anticipated income growth is contributing to the financial pressures felt by many. In response to these financial stresses, more than 1 in 5 Canadians, or 22%, plan to take on additional credit or refinance existing loans within the next year. Among this group, nearly half, or 43%, intend to apply for a new credit card. This trend highlights a reliance on credit as a means to manage cash flow shortages, even as 49% express concern about the impact of interest rates on their ability to repay debts. Many Canadians are actively working to reduce discretionary spending in an effort to ease financial burdens. Areas such as dining out, clothing, entertainment, and travel have seen cutbacks, with 84% of households reporting reduced spending on eating out. Housing affordability continues to be a major concern, with 57% of respondents citing rising home prices as a deterrent to purchasing property. Consequently, only 14% of Canadians plan to take out a new mortgage in the next 12 months. Generation X respondents are particularly affected by the increasing home prices, while millennials point to high interest rates as their primary concern. Matthew Fabian, Director of Financial Services Research and Consulting at TransUnion Canada, commented on the situation, noting that while interest rate reductions may offer some relief, the persistent economic pressures have left many households in a precarious position. With more than half of households expecting their income to stay the same in the next 12 months, added liquidity created by anticipated further interest rate cuts should create some room to breathe and fuel optimism for 2025, Fabian stated. As recession concerns loom, 71% of Canadians report reducing their spending to prepare for potential economic downturns. Building savings and paying down debt are common strategies being employed. This cautionary approach coincides with record-high consumer credit debt, which reached $2.5 trillion in the third quarter of 2024. While measures such as interest rate reductions may provide temporary relief, it's clear that many Canadians remain financially vulnerable. In a noteworthy development across the Canadian real estate landscape, the average asking rent fell to $2,109 in December, marking its lowest level in over a year. This is according to the latest data from Rentals.ca and Urbanation. The report highlights a 3.2% decline in rents compared to December of the previous year, marking the 5th consecutive month of decreases. This downturn follows years of significant rent price growth, with average rents rising by 8.6% in 2023 and an even sharper 12.1% in 2022. Despite the recent cooling, rents are still 16.8% higher than they were 5 years ago. Sean Hildebrand, president of Urbanation, attributes the slowdown in the rental market to record-high apartment completions, a deceleration in population growth, and economic challenges faced in 2024. He noted, "The rental market softened across most parts of the country last year. Current trends suggest rents may experience further decreases in 2025, which so far have been focused on secondary market units." However, Hildebrand believes any declines should be temporary and minimal due to a long-term undersupply of rental units in the country, with rents set to accelerate in the coming years as the current slowdown in construction restricts supply. Ontario saw the biggest drop in rental prices last year, with average apartment rents falling 4.7% to $2,332. This was a sharp reversal from the 3.7% increase in 2023, showing how quickly market conditions can change. Even with the decline, Ontario remains one of the most expensive places to rent in Canada, second only to British Columbia. In British Columbia, rents dipped slightly by 0.5% to an average of $2,487. This marks the second straight year of declines, following a 1.4% drop in 2023. Despite these decreases, British Columbia and Ontario continue to top the list as the priciest provinces for renters. On the other hand, Manitoba saw rents climb 5% in 2024, bringing the average to $1,618. This was right in line with the 4.9% increase seen in 2023, making Manitoba the leader in rent price growth last year. Alberta, meanwhile, experienced the most noticeable slowdown. After rents soared 15.6% in 2023, growth cooled to just 1.6% in 2024, with the average rent reaching $1,718 by December. It's a reminder of how rental trends can vary widely depending on the region and market conditions. Let's take a closer look at the year-over-year rent changes in some of the country's key markets as of December 2024. In Calgary, Alberta, average rent was $1,921, marking a 7% decrease. Halifax, Nova Scotia, saw a 10% increase, with average rent at $2,323. Montreal, Quebec, experienced a 1% decrease, bringing the average rent to $1,998. Ottawa, Ontario, saw a 3% decrease, with average rent at $2,165. Regina, Saskatchewan, had a 1% increase, with average rent at $1,308. Toronto, Ontario, experienced a 7% decrease, with average rent at $2,632. Winnipeg, Manitoba, saw a 4% increase, with average rent reaching $1,624. Vancouver, British Columbia, experienced a 6% decrease, with average rent at $2,882. Lastly, Victoria, British Columbia, saw a 3% increase, with average rent at $2,362. These figures illustrate the diverse rental market trends across Canada, reflecting regional economic conditions and housing supply challenges. As we move further into 2025, it will be interesting to see how these trends evolve, particularly as economic factors and housing policies continue to influence the market. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder: Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.